let's hit that next slide here. Starting with inflation, wanted to highlight to folks as they think about the challenges going on in this environment. Inflation, 1/3 of the CPI metric, Consumer Price Index metric, which is not the Fed's preferred measure of inflation, by the way. I'll get to that in just a second. But it's a decent metric. It has a long history going back many, many decades. But 1/3 of the inflation metric is based on housing costs. And I like to remind folks that, a majority of folks right now in this country, a majority of households have fixed rate mortgages. So in essence, the pressure on rents, the rising prices on rents hit particularly the lower income families, but those are just a feeling of very different dynamic than we are in other households. So for example, me personally, I was working for Visa before I came from LPL. I was looking at global economics. I was based in the San Francisco Bay Area. My office was in San Mateo, Silicon Valley. And during the geographic reshuffling that we're seeing across the nation, I moved back to Charlotte, where I started my career. I started my career on the trading floor of Bank of America. So I said, all right, I don't need to be in Silicon Valley. I'm going back to my roots. In essence, I experienced real deflation, not inflation, moving from West Coast, or shall we say the left coast, to the Southeast again. Highlight just the fact that inflation is highly unique to each individual in this country, and it's very different depending on particularly homeowners versus non-homeowners. Just something to kind of think about in context. But go to the next slide, and I'll give you the raw data, if you will, on how the inflation story looks right now. So this is over the last decade. This is the graph of two of the metrics that people talk about with inflation. So CPI, I just talked about that. It's not the Fed's favorite because it tracks a fixed basket of goods. And as we all know, when relative price changes, we move from one and substitute to another. That substitution effect is captured in the deflator that comes out of the personal consumption and spending and income reports. In fact, we're going to get that on Friday. So it's highly important. Tomorrow, by the way, it'll be a GDP number, but Friday is going to give us the latest deflator number that comes out of the personal income and spending reports. That's very important. That's why I highlighted it in the dark blue and the orange lines. And bottom line here in this country is inflation is past peak. It's easing, it's decelerating fairly quickly and across the board. There's one sticky component, and that is the housing and rentals in particular. So go to the next slide, and you can see a little more detail on what I'm saying across the board, except the lagged effects of rent. So you don't need to memorize this chart. This is a dashboard, by the way, that I put on social media and kind of update this as we go throughout the month. But this basically looks at this inflation dashboard. We say, okay, what about import prices or producer prices or different components that manufacturing firms are realizing with input costs? And the bottom line, except for rent, if you're reading from right to left, it's going from red and orange and yellowish to green as you move to your right, except the rent. And I just wanted to highlight the fact that what I think is going to be turning pretty soon in the rent component as well is really two observations. One is that new leases have declined across the board. It's existing leases that have not yet declined. However, we're starting to see this decent backlog of construction projects happening right now, particularly multifamily. That's going to come online sometime throughout this year, 2023. Increased supply of opportunities for condo and for apartment rents, clearly going to push down the prices in that last sticky category that we say sticky prices. I don't know where that came from, other than just it tends to stick around longer, doesn't revert and respond as quickly to other market dynamics. But go to the next slide here, and you'll see in summary for this first hot topic. This is where we're kind of step back here. What's the takeaway on the inflation story? And the takeaways are these. Think about how hard lower income folks do get hit harder. We are past the peak. We're starting to ease. And what markets care about is not that we're back in the long run 2% range, because that's going to take a while. But what I think the markets care about and have responded favorably with is the fact that we're not at 9.5% like we were last summer. We're at 6.5%. We've gone from the 9s to the 6s. That directional change is a net positive for investors thinking about where to go from here. So it's the direction that matters, and inflation clearly is cooling off in this country. Interestingly enough, we're starting to see the narrative begin to develop even in Europe, for example. It took a little bit longer, but the inflation narrative of past peak is starting to show up there. So let's go to the next hot topic here. Next hot topic is recession. And what I'm going to show you here is proof that I believe that 2 consecutive quarters do not necessarily imply a recession. So 2 consecutive quarters of negative growth is not a necessary and sufficient condition for recession. So here is kind of the debate. I want to kind of set things straight for all the confusion that's in the marketplace right now, particularly with just kind of that mainstream media conversation. We had 2 consecutive quarters of negative growth in 2022, Q1, Q2. That's what I'm showing here on this slide. Look at that black line. It's below zero. There's your 2 consecutive quarters of negative growth. The reason why it's not a recession, in my view, is that consumers were still spending, particularly on services, at a fairly decent clip. Look at the green. That's why I highlighted spending on services on the slide there. The green going from the end of 2021 all the way through the back half of 21 through 2022. Look at how that green category has stayed above the zero line, meaning it's contributed to growth on a consistent quarter in, quarter out basis. You can't have a recession if consumers are spending that consistently. Now, granted, you could also argue the labor market was too strong, but I'm just kind of focusing on this component of consumer spending. By the way, just a little bit of trivia. I think it's fascinating to contextualize this. It's good to be a student of history, whether you're in the markets actively or not. It's always good to understand the history. We have had 2 consecutive quarters of negative growth in this country without recession, but you have to go back a while. You have to go all the way back to 1947. 1947, we're coming out of World War, massive relocation and reallocation of labor, capital, and production, purposes in this country, going from, war production to post-war production. So there was a shakeup in the economy, and headline growth was negative, but there were certain categories of the economy that were still humming along quite strongly. I think that's a great analogy for where we are here. Now, no way that this was necessarily the catastrophe of a world war, but in essence, a pandemic, a global pandemic where labor and capital kind of there's a mixed mash between demanders and suppliers, and you had quite a challenge throughout the reopening, which was 2021, and then 2022 was kind of trying to come out of that reopening, and then of course getting hit with geopolitical problems from Russia invading into Ukraine. I think that shows you why you can have negative headline numbers without recession. So next slide here, we're not in recession, bottom line, but we're probably going to be in one soon, if not maybe in December. That's, it's a little bit of a wild card. I think, if you look at from the conference board data, this is what the conference board gives us, public data. You can go to the conference board website and look at some of their data on here. But whenever you have this change over a 6-month period, this is a 6% change in the leading indicators coming out of the conference board. We've never had leading indicators this low without a recession coming very, very soon. Right. So you think where we are now, we probably will be in one, if not in December, but in one. But But I think what's important to think about is we're probably in this environment where the markets have bottomed before the recession has even started, given the fact that this is the most talked about upcoming recession ever in the history of this country. Go to the next slide. And so wanted to, get a little more detail here. What's going to be challenging, I think, in 2023, by the way, we'll get 2022 data on growth tomorrow morning, 8:30 Eastern time, but still it's in the gray shaded area because it's a forecast. 2023 also a forecast. 2023 is going to be a challenge. And again, going back to the theme of finding our balance, I think the first half challenges, we still have some challenges on a number of fronts, particularly residential real estate, but consumers are starting to retrench. We saw that in December, in the December spending numbers. And we're actually starting to see a little bit more cooling in the labor market with layoffs, et cetera. But the latter half of 23 actually could set itself up to realize a little bit of growth, eke out maybe a 0.5% growth in 2023 as a whole, because 2023 is going to be really a tale of two economies or two time periods. The first half is going to be a little more choppy. We're riding that bike and perhaps getting a few nicks and bruises on our way as we find our balance. But the latter half is going to be a little bit more stable. Go to the next slide here. And wanted to highlight, again, going back and tying it to markets. And this is something we've talked about in our Outlook as well as our blog, which is publicly, facing lplresearch.com. So if you have interest in following us regularly, we like to tell folks that whenever you have a shock to the system, this goes back to Black Money in the 80s, Gulf War in the 90s, the Asia monetary crisis, the tech bubble in the early 2000s, you have these shocks to the markets, and markets, get hit pretty hard. There's your negative returns. 12 months after, look at how much the market has responded and rebounded afterwards. So, for example, even Black Monday, late 80s, down 33%. 12 months later, S&P 500 was up 21%. So what we did here when we wrote this blog and wanted to highlight it in this webinar is the fact that, in general, most of the time, we're not in recession. Most of the time, we don't have these negative shocks to the economy. Most of the time, we're growing, and valuations and price figures actually respond to that growth. So next slide here, kind of summarizing this hot topic again. Here we are. Let's put a bow on this here. Recession. Don't get misled about the 2 consecutive quarter thing. The official definition of recession has to have 3 ingredients. You have to have a pretty massive, deep decline in growth. You have to have it broad-based, meaning it can't be just in one sector. It has to be across broad bases of the economy, and it has to last for more than a few months. Depth, duration, and diffusion, we call it. We call it the 3 Ds. That's what I've blogged about, the 3 Ds of a recession. And that helps us kind of articulate why we weren't in one for most of 2022. So let's go to the next hot topic, which is the Fed. I started my career on the trading floor, as I mentioned, and I remember to this day hearing one trader yell to another trader with a lot of colorful language saying, "Would you pick up the phone? Greenspan is on the line." He was a very interesting fellow, but he kind of started the idea that the Fed likes to keep close relationships with big businesses. So B of A, great footprint across the country on deposits and remittances back to Mexico, for example, all kinds of interesting, activity from a behavioral standpoint. And Greenspan kind of started this culture of that relationship. That's continued on with Bernanke and Yellen and Powell. But what is a little bit unique with the current Fed is they're not really interested in being as cloudy as Greenspan would say. He says, "I guess I should warn you, if I turn out to be particularly clear, you've probably misunderstood what I've said." He loved that. That has clearly changed as well. That culture, a lot more public revealing of what they're looking at, particularly at Bernanke, but Yellen and Powell have continued on that culture. So let's go to the next slide and talk about a little bit on what the Fed cares about right now. They're focused on the job market, particularly if you go even to the next slide. I think this is helpful to think about it, particularly the tightness of it. So this is the quits rate. So you think about labor market churn, right? We have people moving from one coast to another coast. We have people moving jobs, moving locations. Hybrid work environment has allowed for that. Well, there's been a lot of churn, particularly in the construction space, right? In fact, the last 18 months, one of the most challenging factors for businesses have been they can't even find qualified workers. That's been one of the challenges. What I think is a leading indicator here, kind of giving us a little bit of comfort knowing that the labor markets are improving, is that quit rates, in particularly the construction sector, has gone back down to pre-pandemic levels. That's the blue line here. That's orange line is quit rates across all categories. Blue is their construction. And the point is that workers know we're going into the slowdown. They're not as driven to quit one job looking for another, right? Hopping from one to another, trying to get a better wage, a better contract. And the point is, when quits rates go down, that is a sign that labor markets are cooling. That's actually going to be good for the Fed, because the Fed could say, hey, we can actually begin to think about pausing or think about cutting rates because inflation is cooling and the labor markets are cooling as well. Next slide. All right, so Fed here. Wanted to just say one thing about Fed before we go too much longer here. There's this massive tug of war going on in the markets right now. The Fed has said we're going to hike next week, we're going to hike in a couple weeks later, and next month, and then we're going to keep rates elevated for the rest of the year. Markets, on the other hand, have said no. We expect the Fed hike next week, maybe another time. After that. And then as the economy weakens, the markets have priced in, if you look at kind of the forward curve on rates, the markets have priced in an actual cut in rates the latter half of this year. I actually think the market's right, the Fed's wrong. The market's right because we are seeing this cool down, if not outright recession. A recession does seem likely. Fed will respond when those signals become a little bit more clear and convincing to the central bankers right now. All right, so let's go to the next hot topic, and that is the real estate market. Before we get to the summary, I just want to highlight this here, and this is in the point number 3 in this tale of two economies here. I think it's fascinating when you think about certain areas of the economy. We already talked about this with inflation. We said, inflation is very different depending on who you're talking to. A homeowner, a renter, an upper income person with a white collar job, another person, blue collar. What about a restaurant owner? Very, very different experience, both from the inflation side as well as kind of business side. We see that particularly in real estate as well. And that is this tale of two economies. So here's kind of my summary, then we'll open up for Q&A. Wanted to go crisply enough here to allow you to have some takeaways from the webinar, and then as well as giving you some opportunities to give some questions out here. So market's right, Fed's most likely going to cut later this year. That's going to be very helpful actually for the interest payments on debt, perhaps even debt ceiling kind of debates. I think there's a lot of drivers for the Fed to actually cut rates the latter half of this year. Not yet. They'll hike next week. We do have that baked in our forecasts. I think they'll hike by 25 basis points, or 0.25%, when they announce the decision next week. But when you're talking Q3, Q4, there's a good chance the Fed actually cuts. CPI is cooling. That's summary point number 2. Point number 3 is these tale of two economies. 4 is, we've been starting to remove some of our underweights to Europe, and we're actually starting to put a little more allocations toward exposure to Europe, because we think that narrative of improved sentiment from inflation cooling is finally showing up. It's been a while, right? We started seeing inflation cooling months and months ago. You're starting to see that in Europe. But I think in some, you think about the headwinds last year, inflation a problem, at least the first half of the year, first half of 2022. China's zero COVID policy was a real challenge, was a real headwind, because they kept on shutting people down. Of course, the Russian invasion was a headwind. I think there could be those things could turn into tailwinds for 23 because inflation's cooling. China has revamped their COVID policy. And then, of course, perhaps maybe a closer and tighter chance of getting some resolution in Russia. In fact, sending tanks and support to Ukraine. That was literally just announced at 12 noon Eastern here by the President of the United States, as well as announcements from Germany and a number of other NATO countries. So it's possible to actually see some closure there in the Russian side of things. So there you go. There's our summary. We went kind of fast. Wanted to make sure we had some opportunities for Q&A.